Deflation is coming. Inflation is easily one of the hottest topics in the US stock market this year. With the prices of various raw materials going up, many well-known investors, including Buffett, Dalio, and Michael Burry of The Big Short, have all publicly stated that they think inflation is here to stay for a long time. However, Cathie Wood does not think so. Not only does she believe that inflation won't get worse, but instead it will decline, which may even lead to a bigger crisis, deflation. What kind of economic data did Cathie Wood see to make such a contrasting judgment from the other investment gurus? And if deflation does occur, what impact will it have on the market? In today's video, we'll break it all down for you. If you are discovering this channel for the first time and like investing in stocks, please like, subscribe, and hit the bell for notifications. We're bringing you a new video every week on the latest stock market. Before we get into the specifics, let's step back and take a look at the macroeconomic environment of the US right now. There are a few things happening here. COVID-19 still stands at the forefront of today's global issues. Since the Delta variant hit, the number of daily cases began to increase again, resulting in a much slower recovery of employment than expected. At the same time, the stimulus checks from the US government are about to end, and consumers' willingness to spend will inevitably decline. The Federal Reserve has since began talking about tapering to reduce the purchase of central bank assets, meaning that there will be less liquidity on the market. All of these support Cathie Wood's view that deflation, not inflation, is coming. Let me explain one by one. Since the beginning of the year, the market has expected the economy to recover strongly. Many of the most impacted industries by the pandemic, such as airlines, cruise lines, and restaurants, all saw a big jump in stock performance as a result of that expectation. But is the economy really starting to recover as quickly as people think? Data from August's report on non-farm payroll suggests otherwise. Non-farm payroll measures the number of workers in the US excluding farm workers. It makes for a pretty good indicator of whether the labor market is strong or not. The US Department of Labor will release the non-farm payroll report once a month, and economists compare the released figures with predicted figures, last month's figures, and the year-over-year figures to judge the health of the US economy. So, how did the labor market perform in August? To many people's surprise, the figures released in August were much lower than expected. Economists had expected the labor market to be exceptionally strong in August, predicting 730,000 new jobs. The real number? Only 230,000, merely a third of the expected number. While it's almost always expected that actual data differs from economist expectations, this gap is so big that it's nothing short of shocking. Investors are worried. What has happened to the US economy? Cathie Wood believes that the increase in COVID numbers is a significant factor that has caused this unexpected slowdown. The data proves this. Firstly, manufacturing hours worked were down 0.5% when compared to last month. This number doesn't look high, but as monthly data, this translates to an annualized decline of 6%. That's scary. Secondly, while employment in the leisure and hospitality industries has been rising steadily in the past few months, the employment numbers for this month have stagnated. Even the industries that were expected to recover the most from the pandemic's impact have now been hit again. It seems like employment recovery in the United States won't be as rapid as once predicted, which means inflation seems even more unlikely. Additionally, government subsidies have decreased and so has consumer confidence, further reducing the likelihood of inflation. The stimulus check of $2,000 per person has ended, leaving most people with a smaller spending power. Cathie Wood points to car sales figures to prove her point. Car sales peaked this year at around 18 million sales in April and have since fallen to 13 million in August. A near 30% decrease in just 4 months is scary, and Cathie Wood believes this is an indication of a lower consumption demand. Many consumers have already bought cars since the beginning of the lockdown and probably will not buy another one for a long time. Of course, as soon as Cathie Wood's remarks came out, Twitter had something to say back, as Twitter always does. People pointed to a global shortage of chips as the reason for car sales decline. Without these chips, cars couldn't be produced, so this is a decline of supply, not demand. They have a point, as the parking lots of many car dealers in the United States are currently empty. But Cathie Wood also provided another set of data to defend her point: used car prices. Since last summer, used car prices have soared, and yet from July onwards, prices have trended downwards. If the decline in new car sales is affected by chip shortage and not lack of demand, then the price of used cars should have continued to increase. However, the drop in the price of second-hand cars is likely a result of the low buying power in the US. The last reason Cathie Wood gives to explain her position is that hot money in the market seems to be decreasing. We can see this from the growth rate of M2 currency. In summary, M2 currency refers to any currency that can be used as a purchasing power. It represents how much spendable money is circulating in society, and it's one of the most commonly used indicators to judge monetary policy and economics. Since February, American M2 growth has fallen from a peak of 27% to 12% in August. This figure is still higher than the 6 to 7% before the pandemic, since the Federal Reserve hasn't stopped quantitative easing yet. But Cathie Wood expects M2 growth to fall even further. Her reason is that she suspects Biden's $3.5 trillion infrastructure bill may not pass. Americans are worried about inflation, and this has led senators to become more cautious when spending. Therefore, it is very likely that the final passed bill will be much less than the expected $3.5 trillion expenditure. Cathie Wood cites the words of Joe Manchin, a Democratic senator from West Virginia. Although he is in the Democratic Party like President Biden, he believes that a $3.5 trillion infrastructure plan is simply too costly. Right now, the debt scale and GDP ratio of the United States has reached 1-to-1, a number that usually stays in the 70 to 80% range. If government spending is to be further expanded, it will only increase the fiscal deficit and lead to inflation. So, Senator Manchin is opposed to Biden's infrastructure plan, and he has an important vote. If he does not agree, the infrastructure plan will likely fail. Cathie Wood estimates that Manchin will only support infrastructure projects of around $1 trillion, a significant decrease from the proposed bill. Given these reasons, we can understand why Cathie Wood thinks that inflation won't last. What she really needs to worry about is the possibility of deflation. Compared to inflation, deflation is much scarier. It's common knowledge that economic development requires money for investment, production, and consumption. However, with deflation, liquidity decreases, spending halts, and the economy stagnates. It's a terrifying prospect. Fortunately, Cathie Wood believes that there is a long-term solution to the problem: technological innovation. The COVID-19 pandemic forced everyone to stay at home and work, and this phenomenon virtually accelerated the speed of the economy's digital transformation. During this period of work-from-home labor, many companies have improved their efficiency and abilities through means of software innovation. Cathie Wood mentions cryptocurrency and electric cars as examples of technological innovation changing the economy for the better. Bitcoin has risen in popularity these past months because it hedges central banks' assets more effectively than gold. Whereas gold production increases every year, Bitcoin was designed to have a limit in volume, making it very effective against inflation. And with rising concerns about inflation, Bitcoin's price has skyrocketed this past year. Similarly, electric cars have provided an alternative to traditional options on the market. With soaring oil prices and rising car prices, consumers have recently opted to purchase electric cars. From here on out, the popularity of electric vehicles will only grow, and there's no doubt that electric cars will continue to change the car industry as more and more people buy them. While Buffett, Dalio, and Burry are worried over growing inflation, Cathie Wood is worried about the inverse. It is in such differences that the market, hopefully, will reach a balance point. Her hot takes on the hot topic of inflation this year are as insightful as they are controversial. Do you agree with Cathie Wood? Let us know in the comments below.